Hello, everybody, and welcome to this week's podcast here. My name is Miles Clark. I'm joined here by good friend and colleague Jamie West. How you doing, Jamie?
Doing all right, Miles. How about you?
Well, I'll tell you. So typically, you and I aren't on too frequently together, but David, when he comes in, one of the other analysts, he and I and some of the other guys in town will go get ZZQ. Well, he's not in town, but David, we had ZZQ, if you're listening. And I mean, they have the Tres Hombres, which is the brisket, pulled pork, and habanero sausage on there, all in one sandwich. And I'll tell you, we came back. Probably the last thing I wanted to do was come in and record a podcast. So
Perfect for
that,
a nap.
but with all that said, no time for a nap because there's a lot of stuff to talk about. Markets over the last week, hitting or at least sitting super close to all-time highs. But I'll tell you, we're in the dog days of summer. It's been relatively quiet, hasn't it?
Yeah, I think we hit a new all-time high, I believe, yesterday, and then kind of pulled back a little bit, and that's kind of how it's been. We kind of notch these new all-time highs, and then we maybe pull back a little bit, but so far market's not exhaling significantly. We're kind of staying near those highs.
Yeah. No, I mean, and listen, quiet improvement is often just that, right? I mean, you don't necessarily hear people talking about all-time high, all-time high, all-time high when things are going well, right? So, consistent improvement is a relatively good thing, and domestic equities in general seem relatively content in their lead within first. Now, talking about our kind of first topic as we go through our five charts for the week. The thing that might have, at least we thought was going to put maybe a damper on domestic equities, the hot PPI report this morning. It was very hot, wasn't it?
Yeah, very coming in very hot, and probably more surprising because CPI kind of came in line with expectations, and then today you had CPI coming in at I think 3.7% over year, which was about a percent higher than the previous.
Right.
And we have been pricing in a better than 50% chance of three rate cuts by the end of the year. That is now down to about 40%. So the market no longer thinking we're going to get three rate cuts by the end of the year. The most likely scenario, at least now according to the futures market, is two by the end of the year.
Right. Two by the end of the year. And even with the hotter than expected reading today, still pricing in, it's kind of all but a foregone conclusion that we're still getting a rate cut next meeting, correct?
Yeah, right now I think the odds are about 94%. They were 99% yesterday, so a little bit lower, but if nothing changes between now and then, yeah, it'd be an all but foregone conclusion that we are going to get a rate cut next month.
And let's talk for the viewers just for a second, because I know sometimes it can get a little bit confusing. The reason why higher than expected inflation readings of any sort, whether it be CPI, PPI, was it CPE, whatever it may be, right? Higher than expected readings there hurt chances of rate cuts because the Fed is going to say, well, inflation isn't gone yet, right? We have to keep rates a little bit higher. So if that's the case, right, that's what's hurting those chances. Am I right?
Yep,
Okay.
that is exactly right. And I think, this time with PPI is not one that's watched as closely as the consumer numbers,
Right.
PCE and CPI. But I think, everyone's been waiting for the tariff inflation to show up. PPI is producers, so then it feeds into consumers. So I
Right.
think, the Fed potentially going to look at this as maybe a warning shot
Right.
that inflation that they've been expecting is coming, and it's just not showing up in consumer inflation
Right.
yet.
It's because it's at a different part of the manufacturing, or I guess, the consumption cycle
Right.
essentially of producers versus actually what the consumer is seeing. So that's definitely going to be something to watch out for. Of course, markets have been really gearing up for cuts. Of course, and who even knows? No political statement here, but who knows if even the data is real?
Yeah.
So there's a lot of headlines that could come through, in between now and our next podcast, or even over the next, before the next meeting. Let's put it that way, where those cuts could come.
Yeah, and I mean, you may see the market kind of sit on its hands for a little while. I think PPI definitely leads into CPI, but there is the possibility that, producers will just have to kind of
Eat
eat.
it.
Yeah.
Yeah.
And if that's the case, then, you may not see the Fed get too worried because that consumer inflation number that they really worry about kind of stays the same. So we'll kind of see how that plays out. It may take about a month.
Now, I mean, this is getting out of the realm of pure technicals, and I promise for you chartists out there, we're going to start talking about them in just a minute. But, when you talk about producers having to just eat some of those costs, what do you look at specifically to see like, hey, is there consumer appetite to pass on costs, or like what can we look at to see if it will translate or not?
I think if you had a really good answer to that one, you could probably
Right.
have a very good job at the Fed.
Yeah.
I mean, I think, probably the strength of the labor market, things like that, which hasn't been great.
Right.
So there may be kind of less appetite for, producers to try and push these costs onto consumers, because they're worried about losing market share, things like that.
Yeah. Well, you and I were talking a little bit before, like what areas, of course, rate cuts, if when they do come, that could set domestic equities just in general, set them up nicely. One area that possibly could see a bit more of a tailwind could be small caps. Right. I mean, you think about how these guys are financed, right? They're taking on a lot of debt to fund operations. A lot of that debt is going to be, of course, influenced by, the overall rate at which they can borrow. So, a decrease in that rate would, of course, bring down their cost of borrowing and things like that. So, small caps saw a really big rally, maybe not necessarily due to the increase or I guess cooler CPI reading earlier, but they saw a really big day earlier in the week. I think it was quite historic.
Yeah, the Russell 2000 outperforming the S&P 500 by about 185 basis points, which, up near what, like the top 2% of all spreads
Yeah,
between the two. So definitely an important move, kind of a signal that maybe small caps are going to play a bit of catch up. Obviously, they haven't kind of enjoyed the bounce off the bottom that large caps have.
right.
Um, but definitely could be a sign that small caps are going to play catch up. I will say we have seen these not work
Work.
out a couple of times.
Yeah, work.
I think it it last year where there was
Name
that.
a year, 23, 24, 25, right? I mean, yeah, but
Yeah, well, we saw small caps outperform large caps by like 10% over a week. And then, yeah, I think it was last year because it was right before the yen thing. And then it
yeah,
all
yeah,
just
yeah.
kind of fell apart. And small caps sold off harder than large caps, and they never kind of caught up again after
Yeah.
that. So, definitely something I think interesting and to keep an eye on, but just a, bit of a caveat that sometimes these don't really signal a changing of the guard, so to speak.
Right. And if you look, I mean, Dorsey Wright has a fund score system that ranks funds from 0 to 6 based on how strong they are, 0 being the worst, 6 being the best. You look at representative like IWM, right? I don't have the chart pulled up in front of me right now, but I think that that's teetering on a 3, or around a 3 if it's even below a 3. And so the point is that, we have seen improvement off of the lows, certainly, but it's not there in terms of the overall long-term strength that we've seen from the core of the market, SPY, Qs, things of the like.
Yeah, so I just pulled it up. IWM sitting at a 3.2, so
Yeah,
acceptable, but not
yeah,
not great. And still, trading below the all-time highs that it hit last year. While obviously we've seen large caps, well past where
yeah.
they were before the April sell-off.
Yeah, no, I mean it's again something to watch out for. And a lot of people will sit here and say, okay, well, is it too late? Is it actually just early? Especially if we're saying there's a little bit of catch up to play. I think that what I would say, and this is my read on it, is that those all-time highs will most likely be a point of steep resistance, right, as we kind of move through 2025. And ultimately, I think your risk to reward profile on small caps isn't that great. Just using that resistance point or those all-time high points as kind of a resistance point versus ultimately you could fall back down, quite easily down to the 2025 lows if things kind of just fall apart for small caps. So be careful. I think that's the point that I'm trying to make. Be careful when you're trying to catch this stuff because things can move against you rather quickly within that area.
Yeah, and IWM now at about 69% on the OBOS, so
Right.
approaching that heavily overbought territory. So yeah, probably not exactly where you want to get in, or maybe not exactly when you want to get in. If prices kind of normalize around here for a while, then maybe it's something you want to look at, but it's looking a little hot right now.
Yeah. Well, speaking of, kind of movement off of 2025 lows, we did put out an interesting research report. And now that we're about 4 to 5 months off of those lows, talking about how different sectors have done and really what has led those sectors higher over the course of this rally that we've seen the new all-time highs. And so what we've done is we took representatives for the kind of cap-weighted sectors, so your Spider Select Fund, your XLK, XLB, all that stuff, and then compared their performance just from a pure percentage perspective, compared the cap weighted performance versus the equal weighted performance, right? And a lot of it, because we have seen narrowing breadth, right? A lot of it, your cap weighted names have done well. So think about your XLCs, your XLKs. There's been a couple areas though where there has been more equal weight or equal weighted names have done a little bit better, right?
Yeah, I mean, you nailed it. Technology and communication services, the two biggest spreads in favor of cap weighted funds.
Right.
And then on the other end of the spectrum, healthcare, which has the biggest spread in favor of the equal weighted funds. I mean, the difference with technology and comm services, I mean, that's probably pretty self-explanatory for everybody out there.
Right.
The Mag 7,
Yep.
they continue to push higher. They kind of drive the market everywhere it goes, at least over the last couple of years. And so not really surprising to see that, the smaller technology and comm stocks haven't kept up.
Right. Yeah, and that kind of brings back that conversation with the small caps that we were just mentioning. And they're not small in that equal weight of fund, but you get the idea. Coming off of earnings, these guys did very well, right? Meta, Microsoft, all these guys had relatively blowout earnings across the board. They're going to be leading higher versus, you look at the big dogs within healthcare. United Health obviously is down, I think, over 50% this year.
Yeah.
Just atrocious year. Eli Lilly, right? And other big kind of weight loss drugs, Novo Nordisk, right? All these relatively larger names. Well, it's paid to be underweight those the kind of big dogs of the or I guess maybe more slim dogs now with their Ozempic, but that's possibly one of the worst jokes I've made. But anyways, when you look at healthcare, it's been an area to avoid, broadly speaking, within dolly rankings and things like that towards the bottom. But again, knowing what's leading can oftentimes help.
Yeah, I mean, it's definitely good to stay abreast of where that leadership is. This year it's been pretty easy, I feel like, to kind of keep the pulse of where it is.
Yeah,
It's been technology and comm services, at least when the market's going up.
right.
But that's not always the case. I think a couple of years ago, 2022, nothing was doing well except energy. But if you were watching the relative strength and kind of staying in the area's relative strength, you kind of weathered that okay.
Oh yeah, no, it's true. I mean, you talk about what is doing relatively well, and it's so boring. I mean, it's somewhat candidly, we sit here on these podcasts, and I'm like, Jamie, what are we going to talk about? Like, markets are at all-time highs. What's really led that? It's just technology and Meta, which is essentially technology, but they just named it a different sector. It's just boring. We want to talk about other stuff, but it's just we can't. It's just easy to just,
Yeah, I mean, it's sometimes there's not a whole lot to say when
yeah.
the biggest stocks that everyone knows are the best performing,
Yeah.
and there's really not any major signs that that's slowing down.
Yeah, I wonder when it will. But that's maybe a conversation for a whole nother day. I think the fourth chart, which we kind of talked around, so it won't be a long chart for us, but is XLV. So we talked about the bigger names within healthcare really leading the way to the downside within the sector. I think XLV, again, not looking at the chart currently, but moving to fresh 2025 lows. Am I right?
Yeah, on this, the chart that I have up, it's sitting against support at 128, which was the low for the year. And we may have moved, marginally below that, not
Right.
enough to put a new box, but
Right,
but
right,
we're
right.
right there.
Yeah. So, I mean, I actually, I'll get your opinion on this. There are some people out there that would say, can't go lower, right? We're at the support level, right? What do you subscribe to that, or do you think, okay, that's fine. I think that was a softball, right?
No, I mean, I think it absolutely can go lower. I mean, we look back to 2022. I mean, it was down at 120, and then I mean, there's a whole lot of room for it to go and check out some multi-year lows.
Right,
I mean, by no means do I think that we are uh, at the rock bottom, can't go any lower.
right.
I think of like, oh, crude oil in in
20,
2020 when
right.
it went negative. You're like,
Yeah.
oh,
They
well,
can't pay you.
this thing can't go any lower. It is literally negative. No, I don't think that's the case with healthcare. I think there's probably plenty of room for it to go lower. I mean, some obviously the technical picture is not good with XLV having a 1.27 fund score, trading in a negative trend, now sitting almost at 2025 lows, and probably some fundamental headwinds as well with the cutbacks on healthcare spending,
Spend. Yep.
Medicaid, things like that. I mean, that's money that's not going into the pockets of healthcare companies, insurance companies, things like that.
Yeah. And just a reminder on this one, then we'll wrap up with our last chart. With, Dorsey Wright's going to say avoid this sector completely. It's not always realistic to have no exposure to a given sector, especially with something that traditionally is a little bit more defensive, like healthcare. Finding technically strong names within the sector is going to be the name of the game when the broad sector doesn't look that good. So again, when your kind of bigger names within the area don't look that great, simply avoid them and go find, 4 and 5 attribute stocks elsewhere. They do exist. It's just a little bit more rare.
Yeah, I mean, I think there's a lot of pharmaceutical stocks out there that look pretty strong right now. Um, maybe not Eli Lilly, but
Right.
there are a lot of strong looking drug stocks out there. So if that's something that you're looking for, that maybe an area to check out.
Yes. And we will kind of quickly wrap up with our last chart of the day, which is essentially just kind of a time in the market is going to be timing the market most of the time. So we'll throw that chart up on the page right now. Kind of the point of this is, or I guess, there's a couple of charts we could talk around, but again, being you think about a long time horizon, you think about your entire investment career, whether you're investing for yourself or for a client. The point of this is that over time, right, you're planning for something 30 years from now. Most of the time the market's positive 30 years out, right? And you got the table, so I'll kind of lean on you for it, but
Yeah, I mean, if you're looking 30 years out, I mean, since 1950, looking at the S&P, 30 years out from whenever you started, it has been up 100% of the time.
won't
Uh,
ever miss, right?
I mean,
Yeah.
never say never.
Yeah.
I mean, obviously, this is from 1950. Maybe if you bought right before the Great Depression, because I believe it was from the Great Depression. I don't think we actually hit a new all-time high until the 50s. So possible that, there may have been a 30-year stretch somewhere in there.
Right.
But over the last 75 years, anytime you put money in the market, you've been hired 30 years later. And in fact, you've been at least 10x higher. The minimum cumulative return is about 1150%. So about 11 and a half times what you initially put in over 30 years.
Which of course is not bad. And again, that's your, what is that? You said that's your minimum?
That's the minimum over
30.
30 years
Right.
since 1950.
Now, again, you can, oh, there's a lot of, we preach about headlines and avoiding headlines as much as possible. Of course, it makes sense that the further in that you get all the way up to tomorrow, what is it, a 50, there's like a 52, I don't think that's on there, but like a 52% chance that tomorrow is going to be positive or something like that.
Yeah.
So, that number is going to drastically change the kind of more drastic your time horizon gets. So just keep that in mind when you're looking at this stuff. And you were saying something about annualized returns earlier that I do at least want to make sure that we touch on. Annualized returns over that time frame.
So minimum for a 30-year since 1950, a little under 9%, 8.78. The max 14 point, is that a, yeah, 6. So either way, no matter when you started, you earned at least almost 8.75% on your money. But there's a big spread between those, the best and the worst. So almost 6% between, the max 30-year return and the minimum 30-year return. So, this isn't to say just buy and hold all the time.
Right.
There is that you definitely want to try and move those odds in your favor to getting towards that, 14.5% annualized return. I mean, 6% annualized over 30 years is a whole lot. It's a whole lot. So I think our takeaway from this is, if you have clients who are nervous about getting in the market, they see, oh, it's trading at all-time highs. Yeah, but anytime you bought over the last 30 years, even if it was trading at an all-time high, you know, a few years down the road, you've generally been higher. So it can take some of that nervousness about getting into the market.
Very well said. Again, at the end of the day, it's just, finding tactical ways to get yourself up closer to that maximum value. No one's going to turn their nose at 8% a year or 9% a year. That's pretty much long-term averages on the minimum side. But, like you said, I think there's a couple more cars and maybe a boat or two in a difference between 6 and or 8 and 14% towards the minimums and maximums. So remain tactical when it comes to this stuff. Find times to get in and out of the market, but ultimately we want to be in the market as much as possible.
Yeah, I think it can be a really good way to reframe the risk.
Yep.
People who maybe don't work in the industry, they think, oh, if I invest in stocks, I could lose all my money or half my money. And I think this can kind of show them that over a long period of time that's very unlikely to happen. And perhaps the bigger risk is waiting in cash and you really don't earn anything because that 8.75%, that's a lot more than you're going to earn.
Right.
You
Going
know,
out getting 2 or 3%, whatever, if that, you know what
yeah,
I mean?
yeah.
Um, okay, cool. Any final thoughts? I'll leave it with you.
No, I think that pretty much does it for me.
Okay, perfect. Well, again, we appreciate everyone listening here. It was a wonderful time. We're going to go take a nap after ZZQ here. Got out quick, and we'll see you again next week to touch on any updates. Thanks.